Brad Williams, Frugal Finance. Let's talk about motivation for swaps. With the size and growth of the swap market over the last 20 years, clearly it's a product that works. Today, the swap market is a mature market that is well understood by many sophisticated practitioners. Therefore, there are likely to be few, if any, arbitrage opportunities available. Instead, the swap market has succeeded because it offers more operationally efficient and flexible means of packaging and transforming cash flows than any other instrument, such as exchange-traded options and futures. These uses of the swap market are not motivated by perceived informational inefficiencies. Instead, the motivation turns on reducing transaction costs, lowering hedging costs, avoiding costly regulations, and maintaining privacy. These business applications in an informationally efficient market will be the primary focus of our discussion of swaps. However, we begin by considering a swap transaction designed to exploit a market inefficiency, which turns on the competitive advantage in borrowing costs between two firms. When we then turn to understanding the motivation for swaps for risk management purposes in an operationally efficient market, we consider two simple examples of how firms might use the swap market to manage internal risks. The motivation for these latter swap transactions is operational efficiency and cost effectiveness rather than an effort to exploit an information inefficiency. The comparative advantage: in most cases, some companies have better access to the capital market than another firm. For example, a U.S. firm may be able to borrow easily in the United States, but it might have such favorable access to the capital market in Germany. Similarly, a German firm may have good borrowing opportunities domestically, but poor opportunities in the United States. Notice that this comparative advantage implies an inefficiency in the financial market because the differential access to the market implies that lenders evaluate the firms differently in different countries. Table 24 represents borrowing rates for party C and D, the firms of our fixed-for-fixed currency swap example. In the previous example, we assumed that for each currency, both parties face the same rate. We now assume that party C is a German firm with access to euros at a rate of 7%, while the U.S. firm, party D, must pay 8% to borrow euros. On the other hand, party D can borrow dollars at 9%, while German party pays 10% for its borrowings. Keep in mind, we're not exchanging here. So you're asking, well, isn't there a currency exchange issue and the cost of this and except? No, this is just internal borrowing. If they're borrowing in the US, it's 8%. Party B's borrowing is 9%, etc. Party C, 10%. Party D, 9%. Euros 7 and 8. As shown, Party C enjoys a slight comparative advantage in borrowing euros, and Party D has a slight comparative advantage in borrowing dollars. Again, notice the market inefficiency that these rates imply. In one currency, Party C is regarded as a better credit risk. In the other currency, Party D is the better credit risk. These rates raise the possibility that each firm can exploit its comparative advantage and share the gains by reducing the overall borrowing costs. This possibility is shown in Figure 20.4, which parallels Figure 20.2 but focuses just on the exchange of currencies at the initiation of the swap. Figure 20.4 shows that Party C borrows euro 25 million from a third-party lender at its borrowing rate of 7%, while Party D borrows 31.25 million from a fourth party at 9%. After these borrowings, both parties have the funds to engage in the fixed-for-fixed currency swap that we've already analyzed. To initiate the swap, Party C forwards the 25 million euro it has just borrowed to Party D, which reciprocates with the 31.25 million it has borrowed. Essentially, the two parties have made selective independent borrowings and then exchange the term. For this reason, a currency swap is also known as an exchange of borrowings. Figure 20.5 shows the annual interest rates for the loans and the fixed for fixed currency swap. Party C annually receives euro 2 million from Party D and pays interest of 1.75 million on its loan. This gives a net inflow of euro 250 per year. Valuing these euros at the exchange rate of $1 equals 0.8, the net flow has a value of 312,500. 250 divided by 0.8. Party C also pays 3.125 million annually to Party D, giving Party C a net annual cash outflow of 2.8125 million, 31.25 times 0.09, for the use of the 31.25 million for an effective interest rate of 9%. This compares favorably with savings of 1% financing cost to Party C. Assuming that $1 equals 0.8 euro, Party C borrows dollars at an effective interest rate of 9% as follows. With all values expressed ultimately in dollars, interest payments equal 3.125 million minus euro 2 million times 1.25 plus euro 1.75 times 1.25 equals 2.812 million on 31 million notional. Party D borrows euros at an effective interest rate of 7% as follows, with all values expressed ultimately in euros. Interest payment is equal to 2 million minus 3.1 million times 0.8 plus 2.8 million times 0.8 equals 2 million minus 2.5 million plus 2.5 million equals 1.75 million on 25 million. Each year, Party D receives 3.125 million from Party C and pays 2.18 to 0.5 million on its loan for an annual inflow of 312,500. At the exchange rate of $1 to 0.8 euros, this inflow is worth 250,000 euro. Party D also pays euro 2 million to Party C for a net annual cash outflow of 1.75 million. 2 million minus 250,000 equals 1.75 million. This outflow pays for the use of euro 25 million for an effective interest rate of 7 million. This is better than the EU interest rate that is available to Party D at 8%, as shown in table 20.4. Thus, Party D also saves 1% on its financing costs. By using the swap, both parties achieve an effective borrowing rate that is much lower than they could have obtained by borrowing the currency they needed directly. Party C and D share equally in this example. By working together, both companies can use the slight comparative advantage of the other to reduce their borrowing costs. Figure 20.6 shows the termination cash flows for the swap when both parties repay the principal. Now, what is the only concern from both parties? Counterparty risk. I'm sure there's a way to measure that, but for now, we'll take one step at a time. Try to visualize how all this works. We're exchanging, but we also have to take into consideration the cash flows, the discounting, the exchange rates, so on and so forth. A lot of moving parts, not overcomplicated, but you can just see we have to do some number crunching, and ultimately we'll come up with some pricing on this and determine what is the best route to take. Brad Williams, Frugal Finance, more on swaps.